Right now, somewhere in your country, there is a bank that is about to fail. Not in a dramatic Hollywood way, no alarms, no vault doors slamming shut, no men in suits running down marble hallways. It will happen on a Friday afternoon, quietly, after the markets close, while you're deciding what to have for dinner. By Monday morning, the logo on the building will already be different, and most customers will never know how close they came to losing everything. The question nobody thinks to ask until it's too late is simple. Where did the money go? Not the bank's money. Your money. The number on your screen that you thought was as real as cash in your hand. This is the story of what actually happens to your savings when a bank dies. First, let's kill a comforting lie. Your money is not sitting in a vault. The moment you deposit $100, the bank lends most of it out. This isn't fraud, it's the entire business model. Banks keep only a fraction on hand, sometimes as little as 3 or 4%. The rest is sent out the door as mortgages, business loans, credit lines, car payments, commercial real estate deals. Your balance is not a stack of bills locked behind steel. It's a promise. An IOU from an institution that assumes not everyone will ask for their money at the same time. And for decades, centuries even, that assumption works perfectly, right up until it doesn't. A bank fails when that promise breaks. Maybe it made bad loans that will never be repaid. Maybe it bought bonds that crashed in value. Maybe a rumor spread and customers lined up to withdraw everything at once. The classic bank run. Whatever the trigger, the result is the same. The bank cannot return what it owes. At that point, regulators step in, usually a government agency. In the United States, it's the FDIC, the Federal Deposit Insurance Corporation. In Europe, each country has its own version. And here is where the clock starts ticking. In most cases, the agency already knows the bank is dying before you do. They've been inside the books for weeks, sometimes months, lining up a buyer. The perfect scenario, and the most common one, is called a purchase and assumption. Another, healthier bank agrees to absorb the failing one. Your account, your balance, your debit card, sometimes even your online login, all transfer overnight. You wake up Monday, check your app, and the only thing different is the name at the top. Your money never left. It just changed hands above your head while you slept. But that's the clean version. Sometimes, no buyer steps forward. The bank is too broken, too toxic, too small for anyone to want. In that case, the insurance agency takes over directly. It becomes the temporary owner of your account, and its first job is to figure out exactly how much you're owed. This is where the rules matter. In the US, deposit insurance covers up to $250,000 per depositor per bank. In the European Union, the standard is €100,000. In the UK, £85,000. If your balance is under that ceiling, you are, in theory, made whole. The agency cuts you a check or transfers the funds, usually within a few business days, fast enough that most people barely notice. Now here's the part that keeps wealthy people awake at night. What if you're above the limit? A small business with $400,000 in an operating account. A retiree who just sold a house and parked the proceeds in one place. Anyone above that insurance ceiling becomes what regulators politely call an unsecured creditor. You join a line, behind the insured depositors, behind the tax authorities, behind the secured lenders. You might get 70 cents on the dollar. You might get 40. You might wait years while a team of lawyers picks through the wreckage. The insurance limit is not a suggestion. It's a cliff, and everything above it is standing on the edge. But there is something even stranger buried in the fine print. During certain windows, your coverage can temporarily double or even multiply. In the US, if you just closed on a house and the proceeds are sitting in your account, you may be covered up to $500,000 for a brief period. Joint accounts, trust accounts, retirement accounts, each one can carry its own separate insurance limit at the same bank. The system is more flexible than most people realize, but only if you set it up before the crisis, not after. Nobody reads the manual for a parachute while they're already falling. So, what does a bank failure actually look like from the inside? Let's rewind to March 2023. Silicon Valley Bank, the 16th largest bank in America, collapsed in roughly 40 hours. On Wednesday, the bank announced it needed to raise capital. A few analysts raised eyebrows. By Thursday morning, word had spread through group chats and Twitter threads faster than any press release, and depositors had tried to withdraw $42 billion in a single day. That's a quarter of the bank's total deposits. Gone in hours. The fastest bank run in history, powered not by people lining up at branches, but by people tapping a button on their phones. By Friday, regulators seized it. The speed was shocking, but what made SVB different was its customer base. Most of its depositors were tech startups with millions in their accounts, far above the insurance limit. For one weekend, founders across the country genuinely did not know if they could make payroll on Monday. The government ultimately stepped in and guaranteed all deposits, insured or not. But that decision was extraordinary, a one-time rescue, not a rule. There is no law that says they have to do it again. And here's a detail most people overlook. When a bank fails, your money might be frozen, but so is everything attached to it. Automatic bill payments stop, direct deposits bounce, mortgage payments you scheduled don't go through, subscriptions, rent transfers, payroll for your employees, all of it halts. For a few days, sometimes longer, your financial life is suspended in midair. It's not just about the balance on the screen. It's about the plumbing. Every pipe that connects your account to landlords, utilities, employees, and lenders goes dark until someone reconnects it. And reconnecting it is your job, not the government's. History says this isn't rare. The FDIC has handled more than 560 bank failures in the United States since 2001 alone. Most were small community banks that disappeared without making national news. Places where the branch manager knew your name and your dog's name, gone between one Friday and the next Monday. But each one had real depositors, real businesses, real people staring at a screen that suddenly said something different than it did the day before. In 2008, during the financial crisis, 25 U.S. banks failed in a single year. The next year, 140 more. Some of them were household names. Washington Mutual, the largest bank failure in American history, held over $300 billion in assets when it went down. And those are just the ones that officially collapsed. Dozens of others survived only because governments injected emergency capital, rewriting the rules of capitalism in real time to prevent a domino chain that nobody knew how to stop. Which brings us to the question you're probably asking right now. Is your money safe? The honest answer is almost certainly yes, but only if you understand where the line is. Stay under the insurance limit. Spread large sums across multiple banks. Know exactly which accounts are covered and which aren't.
The system is designed to absorb one bank failing, or 10, or even 100. What it isn't designed for, what no system on earth is designed for, is everyone panicking at the same time. The next time you check your bank balance, remember, that number is not money. It's a promise. And behind that promise stands a chain of regulators, insurance funds, and backup systems built over nearly a century of trial and error, all engineered to make sure you never have to think about any of this. The entire architecture is designed to be invisible. And it works, almost always. But the people who do think about it, the ones who read the fine print and spread their deposits across institutions and check the health ratings of the banks they trust, those are the ones who sleep best when a Friday afternoon gets very, very quiet. Your money is safe, until you assume it always will be. And that assumption, that quiet confidence, is both the system's greatest strength and its single point of failure.
But bank failures aren't even the strangest way ordinary systems break down when the person in charge suddenly disappears. Out in the middle of the ocean, thousands of kilometers from land, a cargo ship captain's heart stops beating. There is no replacement, no ambulance, no pulling over. Just a 200,000-ton vessel, a crew that now answers to no one, and a chain of command that was never designed for this moment. That story is next. And if you don't want to miss it, you know what to do.